There's only a few individual investors, a few active managers that actually buy compounding machines and hold them long term. It's a rare trait. There really is only a couple people doing this, and this man right here is one of them. His name is Chuck Ackrey. The returns that Chuck Ackrey has had over the decades have been astounding. Even in his latest publicly traded ETFs, he still beats the market on a consistent basis up to this day. In the Ackrey focused retail fund, we can see it outperforming the S&P 500 since 2010. That's not an easy thing to accomplish, and he's done so while having better risk-adjusted returns as well. So he's taking on less risk and beating the S&P 500 while doing so. Ackrey summarizes his investment approach into a three-legged stool approach. He gives this visual, saying that he looks for 1, an extraordinary business, 2, talented management, and 3, great reinvestment opportunities and histories. But how many companies actually meet those qualifications? Apparently not many, because in his fund he has 18 total stocks, with the top 3 making up the majority of his portfolio. So he's beating the market for a long period of time. He's somehow doing it by taking on less risk, but he's also running a very concentrated portfolio. On top of that, another thing that Chuck Ackrey's known for is not selling. His sell thesis for stocks is very different than most investors, because Chuck Ackrey doesn't do something that most investors do. He doesn't concern himself too much with valuation. So I've been trying to figure out, how does Chuck Ackrey beat the market consistently while taking on less risk? What is the secret that he's doing? Well, that's what we're going to be diving into in this episode. So let's go ahead and just jump right in. And the first thing that I want to go into is the portfolio construction. They have such a concentrated group of companies, with only 5 making up 55% of the portfolio. That is a level of concentration that most fund managers aren't willing to do. But these guys are doing something different. Here we have John Neff, who is the co-portfolio manager, and he speaks directly about this level of concentration.
As he likes to say, we aren't speculators in the price movement of shares. We own businesses. And the focus is on owning the most exceptional businesses that we can find. And if you're really limiting yourself to exceptional businesses, the list of businesses that you would ever own is going to be a short list. And that's why we're incredibly concentrated. And if you've identified a great business and you've purchased it well, why would you be in a rush to sell it? So the turnover is very low. We're not trading in and out of these names.
The logic here is astoundingly simple, but yet the majority of fund managers still fail to follow it. They over-diversify into worse quality companies and typically have subpar returns. But John Neff, Chuck Ackrey, they're one of the few that really buy compounding machines.
And extraordinary companies.
Compounding machines.
The compounding machines, right. So why is it so hard to find those companies?
Well, they're scarce.
Yeah.
They have something unusual going on, and oftentimes it is not completely obvious as to what it is that's going on. A great example of that would be a company like MasterCard or Visa. They're earning returns on capital that, as we say, you could cut in half twice and it would still be above average for an American business. So something extraordinary is going on there.
He just said you could take MasterCard and Visa and cut the returns on capital in half twice and still be above the average US business. Now we can test this out. Let's take Wendy's for example. Wendy's is a pretty known company across the United States. If we go down to the ratios chart on Qualtrim, we can see the returns on capital employed for Wendy's. All right, so we have around 7% returns on capital employed. Let's look at a few more companies. We have Activision Blizzard here being sold to Microsoft. We have right here the returns on capital employed that are 7%, 14%, 13%, 9%. So jumping around between 8 to 13%. Let's take a look at Target. Now Target's returns on capital employed are a little bit higher, 15%, 16%. We even have one year where it was above 20%. 27% in 2022 is an unusual high. So we can say that on average, it's around 15 to 20%. That seems pretty high. Now let's take a look at MasterCard by comparison. MasterCard's returns on capital employed over the past decade have averaged around 50%. Most of the companies that we've looked at have struggled to break 10% returns. Target was an outlier, getting up to around 20% some years. So he highlights MasterCard and Visa as two exceptional businesses, and he holds both of these companies in his top 5. Combined, they make up 30% of his portfolio. That seems like it was almost too easy to do. Just find some really good companies, throw the majority of your invested capital into those companies, and have fun beating the market. But there is more to the strategy than that. There's other factors he looks at as well.
So something extraordinary is going on there.
Right.
And the company does not talk about what that is. They never talk about it. We don't talk about it, but we spend a lot of time thinking about it, trying to understand what it is, whether or not it's likely to continue, that sort of stuff.
Why don't you like to talk about it?
I don't think we're giving away anything, but I just want to make sure we're not.
He keeps his competitive advantage close to the chest. He doesn't like revealing his analysis and insights that he sees in these companies because he's a competitive person. He runs a fund, he wants to own these companies, and he doesn't want to give anything away to anyone else. That may seem selfish that he doesn't want to share the insights that he's seen in companies like Visa and MasterCard, but in a way he's just protecting the proprietary research and analysis that they've done. But from the outside, we can make some simple observations. Chuck Aukrey and his fund focuses on buying the top companies in the world. They have the majority of their capital invested into 5 companies. The majority of the capital in those 5 companies are invested in 2 companies. Those 2 companies are MasterCard and Visa. They make up a combined 30% of their invested capital. They obviously must see these companies as extraordinary companies that fit closely within their criteria.
And so the other side of that is a company like that earns rates of returns on the owner's capital that are so extraordinary that they don't have a good opportunity to reinvest their free cash flow in ways to continue to earn those above average rates.
The problem with these companies is that they're so outstandingly profitable and successful that they're literally gushing cash. They have no clue what to do with all of this cash because their businesses are so efficiently ran. Imagine for a moment being tasked with running a company that prints out over $17 billion in free cash flow per year. That's the amount of money that you have in excess of what's required to run the business. You don't have much expenses. When we look at the expenses chart, this is really low compared to their overall revenue. The cash conversion rate of Visa is so incredible that with $29 billion in revenue, they convert roughly half of that into free cash flow. More cash than they can use and more cash than they can reinvest effectively back into their business. Both MasterCard and Visa have maxed out their reinvestment opportunities with their cash a long time ago. So right now, both of them just return the capital back to the shareholder, either through buybacks or dividends. So MasterCard and Visa are 2 companies that have incredibly high returns on capital employed, but not enough avenues to reinvest their cash. Both of them combined make up 30% of his portfolio. Now, the next company we're going to dive into is the second largest holding, Moody's Corporation.
Sure. So it was the summer of 2009, and I was interviewing, and naturally we're talking about ideas. And the primary idea I was pitching to Chuck at the time was Moody's Corporation, which is best known as one of the 2 dominant credit rating agencies in the world.
And had a stellar reputation after the financial crisis, and
well,
right?
In the wake of the financial crisis and during the financial crisis, Moody's actually was one of the poster children for what went wrong.
He has some guts there. I don't know if I could come in during an interview where Moody's is considered the worst company on planet Earth because they caused this huge problem and pitch that as a company that we should buy. But that's exactly what he did. And that shows an investing caliber that's above most investors. Moody's returns over the past decade have been incredibly market beating.
They were roundly blamed for the financial crisis because the ratings were wrong on anything that was related to residential mortgage-backed securities. What I maintained in pitching the idea to Chuck was that while I wouldn't defend the outcome of any of the ratings or the accuracy of the ratings in any way, shape, or form, what I did believe was that the problem was upstream from the rating agencies in terms of that the problem really started with the banks that securitized these products and then misrepresented what was actually in these pools of securities. And that Moody's was taking the blame, but that in fact, that's actually one of the roles that Moody's serves in the debt capital markets, is scapegoat periodically, that the franchise would remain intact.
What an incredible investment thesis on Moody's. Moody's and S&P Global were roundly blamed for the disaster in 2009, while the actual investment vehicles, these complex derivative mortgage-backed securities, were created by the banks. The banks misrepresented what were in those securities, but he still says that Moody's was okay taking the blame. And that's a perspective that I never really considered. That these companies, Moody's and S&P Global, they serve an important role in the capital markets of taking the blame when things go wrong. Having this level of foresight and thought 10 years ago about these companies is incredibly rare.
Back to our three-legged stool, business, people, reinvestment, Chuck rejected the idea on the grounds that the people had to have been behaving very poorly. What we sort of shelved the idea. He hired me anyway. The stock was around $16 a share in the summer of 2009.
Had they bought it right away then, the return would be over 18,000%. But Chuck did initially scrap the idea, and he missed out on that $16 buy.
A couple years later, it was in the low 30s. And I said, and it was still dirt cheap. And I said to Chuck, look, I can talk till I'm blue in the face, but your problem here is with the people, so let's go see the people. So we came up to see the management team of Moody's. I asked most of the questions.
And I might tell our audience that it's like one of your largest holdings, so just so they know that right up front. Yep, okay.
And I asked most of the questions. Chuck listened. Chuck lobbed in a question periodically. And we went back to the office, and soon thereafter we started buying the shares. It was a wonderful lesson for me. Here I am brand new and working with Chuck, but it was a tremendous lesson that I will never forget. And the lesson was that he could have said, well, I'm Chuck Ockery, I've been doing this a long time, I have spoken, and the answer is no. When he was presented with a good case, he changed his mind.
Right.
And that is a tremendously valuable thing to be able to do in our business. You have to do it to be a successful investor. And he showed me in those early days that he was able to do that, and that really impressed me.
Chuck Ockery didn't want to invest in Moody's because he thought that people were bad people. They screwed up bad and they must have been behaving poorly. But then meeting the people and realizing that they're not bad people, he was able to change his mind. Chuck Ockery has had over a 900% return on Moody's, and today he still holds it as a 15% position. So this has been one incredible performer for his fund, and all he had to do was change his mind. Now, another area that Chuck Ockery differs from most investors is the heavily qualitative focused analysis. Most investors today focus on quantitative metrics. And while that plays an important role, it takes another level of detail and effort to really dive into the qualities of a company, how the company operates, their business risks, their competitive dynamics, their market structure, and everything else that goes behind that.
I think at the end of the day, what it comes down to is a really firm qualitative understanding of what makes a business great. We can't screen quantitatively for what it is we're looking for.
So he owns some great companies. We have Moody's Corporation, one of the credit rating agencies that he was finally convinced to buy. He has MasterCard that we've talked about extensively. And then he has 10% into Visa currently, raising the MasterCard Visa duopoly to a 30% position in his portfolio. But there's one company in this top category that takes up over 10% of the portfolio that we haven't heard about so far, and that is American Tower Corporation. It's rare to see a real estate investment trust be a top position in a huge fund like this, but that's what he's decided to do. What is unique about American Tower Corporation?
Today, it is the largest tower company in the world, operates in 16 countries outside the US approximately. If you want growth in wireless communications, it is deployed through a system of antennas, and the antennas are primarily on towers. So the tower companies really sort of own that toll booth today in the growth of wireless, and as we've experienced 1G, 2G, 3G, 4G to less an extent, 5G that everybody's talking about now. Each of those requires a denser network of antenna to, among other things, to increase the likelihood of uninterrupted communications between the devices and whatnot. So American Tower and Crown Castle and some others sit in that space, and it's a very desirable space. And the way you see that, when I talked about rates of returns at the outset, the rate of return on an incremental antenna at American Tower, once they get to break even, the incremental return is probably north of 90%, and which is a very powerful business model.
That means they put the upfront cost of building one of these towers, and then there's almost no follow-up costs, very little ongoing costs associated with it. So everything after their upfront costs is basically pure profit. And he also describes American Tower Corporation as a toll booth business, which matches the other companies at his top 4. So he has a high concentration into companies that have incredibly high returns on capital that also happen to be wide moat toll booth businesses. And throwing the majority of money into these companies, especially when they're offered at cheaper prices, has led to outstanding returns for him and his investors. Now, typically the thought is that even though these guys have had good returns in the past, the gig is up. They've had their good returns, and from here on out, they're probably just going to have so-so returns, basically average returns going forward. That's typically what happens with fund managers, right? They go on a good run, they happen to get lucky buying some companies for cheap, and then the returns average out. Well, Chuck Ockery and his partner here show how that doesn't happen with their firm. They explain how they avoid this reversion to the mean.
We always talk about our ability to do better than average.
Right.
And so when you think about average, so when I think about average, I don't necessarily think of our AUM. What I think of is our ability to stay concentrated. So give me an example. If you flipped a coin, the average outcome would be that 50% of the time it would be heads and 50% of the time it would be tails. The more coins you flip, the more likely you are to get to average. 50% will be heads. The fewer coins you flip, the more likely you are to get an outcome that's deviates positively or negatively from average. So it's really not about our AUM, it's our ability to stay concentrated in our highest conviction ideas, and our AUM hasn't been a problem to date.
The reason that Ockery Capital Management can continue to outperform despite having a portfolio value of $12 billion is because the companies that they're investing in have such a large market cap that assets under management isn't a problem. They can still continue to buy MasterCard, Moody's, American Tower, and Visa. And because these companies continually outperform the broader indices, they can stay concentrated in these group of companies and continually outperform the broader market. Now, all of this may sound easy on the surface, but in practicality, it's very difficult. I can't imagine running a portfolio that's $12 billion in assets and having 50% of it into only 4 or 5 companies. The concentration in combination of selecting a group of incredibly high quality companies and holding them long term, having the discipline to never sell out of them, is what's led to their excessive gains over a long period of time. Most investors that I speak to talk daily about whether or not they should sell a company. This company moved from a 20 PE ratio to a 25. Should I sell it or should I hold? Wall Street's ran by short-term news and price targets, recommendations every single day of the top 5 buys and the top 5 sells, companies that you should overweight and underweight, moving and upgrading price targets from overweight to hold to underweight to strong sell, strong buy, bearish and bullish. The noise of Wall Street makes it incredibly difficult to do the one thing required to have these type of returns, which is having patience. Chuck Ockery addresses this type of noise on his website. With a write-up called The Art of Never Selling, there's one portion of it in particular that I think is incredibly insightful. He talks about price targets. He says that valuations play no role in our sell decision, and neither do price targets. Let me make sure I just read that first line there correctly. Valuation plays no role in our sell decisions, and neither do price targets. That seems like it can't be right, but he goes on to explain why he has this logic. The underlying idea behind price targets is that every business has an intrinsic value and that the goal of an investor should be to buy at a discount to intrinsic value and sell when that discount has narrowed. That's probably what you've had described to you as value investing. Buying at discounts and then selling when the discount narrows. It is compelling to say that you bought the proverbial dollar bill for 60 cents and then sell them later for $1. But with growing, competitively advantaged businesses, however, that proverbial dollar bill may be worth $1 now, but we expect it will be worth $1.20 the next year, then $1.40 after that year. When in possession of these kind of businesses, we believe that you are much better off holding them long term and allowing them to compound. This type of view on selling is dramatically different than what you'll hear from most of Wall Street, but this is what these type of investors are doing silently in the background. And the other thing they're doing that's dramatically different than most of Wall Street is they're beating the market. So there we have a look at Chuck Auchery and his fund. That's all for now. I'll see you in the next one.